All right. Well, hi, everyone. Welcome to Peace of Mind for Farmers, Understanding Crop Insurance. This is the first of a series of 6 farm business webinars co-produced by uh, Washington State University Extension and the North Olympic Development Council. I'm your co-host today, Paul Schiefen. I'm the program manager for the Food and Farm Business Development Program at the NODC. Our program serves established food and farm businesses with free short and long-term personalized business advising and technical assistance, in both Colum and Jefferson counties. If you're interested in learning more about that, please feel free to reach out to me directly. I've got a resource slide at the end of the class today that has my contact information there. So today we're hopeful to demystify crop insurance and have you get some insight into the programs offered by the USDA and how you can use them to better protect your farm from risks that you can't control. We're super excited to have us presenting today Lacey Manasco and Chrissy DeVries from the USDA Risk Management Agency. I'll let Lacey tell you and Chrissy tell you a little more about themselves in a minute. But before we get started, I'd like to introduce you to our co-host, Kelly Henwood, the program manager of the WSU Regional Small Farms Program for Colum, Jefferson, and Kitsap counties. Kelly is going to go over some housekeeping and how things will work today on Zoom. Thanks, Kelly.
Thanks, Paul. Hi, everyone. Nice to meet you. My name is Kelly Henwood, and I work with the WSU Regional Small Farms Program. So for today, we will have a few functions that we want to bring to your attention. All of your questions and our answers for our speakers will be utilized in the chat function. So please keep yourself muted for today's presentation. And if you have any questions that come up, please put them in the chat and Paul and our presenters will address them later on. Beyond the Zoom features, we do have a voluntary race, ethnicity, gender survey that WSU collects to assess where some of our disparity gaps in our education are. So I will put that in the chat. Please feel free to click on that link now before we get going and fill it out. It's very quick. It is voluntary. Other features of Zoom today, if you have any issues with your camera or any presentation mode, feel free to, again, use the chat and we'll help you out. Okay, thanks, Paul.
Thanks, Kelly. All right. Now I'd like to introduce you to Lacey Manasco and Chrissy DeVries. Lacey is the deputy director, and Chrissy is a risk management specialist at the Spokane Regional Office of the USDA Risk Management Agency. They're going to tell you everything you wanted to know, probably, and more about USDA crop insurance. And thanks for being here, Lacey and Chrissy. And they've got a lot to go over, so let's get into it.
I'm working on sharing my screen here. There we go.
All right.
Does that look good? Can you see it? Okay, I'm going to get started. As Paul said, I'm Lacey Manasco with the USDA Risk Management Agency. I'm in the Spokane Regional Office, and we oversee kind of 4 states out here in the Northwest, overseeing our crop insurance programs. So before I get started, I always have to say our disclaimer that everything I'm presenting today is just kind of general information about our programs. If I misspeak or have something that doesn't exactly align with policy, which I shouldn't, this is just for informational purposes. Of course, the policies and the handbooks still rule the day over here. So this is a breakdown of our regional offices with RMA. So what RMA is the federal agency that oversees the crop insurance programs. So these programs are provided all over the U.S., but we have regional offices that really try to be the local experts on the programs and to make sure that they're meeting the needs of the producers. So in Spokane, we really work hard on being connected with the growers in our area and make sure that these federal programs really meet the needs of our producers. The Northwest is really diverse. We have a lot of different things going on than maybe they do in the Midwest, where it's corn, soybeans, and wheat. Um, so we really work hard on staying connected, making sure the programs are working right. Every few years, every program gets evaluated at a really deep level. So we do a lot of industry outreach and see what we can do to really fine tune the program and make it work for producers. And we also work on new product development. Not too long ago, we were out in Oregon working on a grass seed policy and really trying to get the grass seed insurance product that we currently have to work for the growers out here in Oregon who are a little different than the growers in the Midwest. So it's always fun, and we try to be really proactive on making sure we're meeting the needs of the industry. So the way crop insurance works is a little different than your regular insurance, and honestly a little different than other federal programs. So the risk management agency is really in charge of developing and maintaining the programs. So all the rules, the handbooks, the policies, things like that, we oversee all of those things. And we have a compliance division that makes sure everything is being administered correctly. There's no fraud or abuse in the program. We do outreach to producers and talk about what tools are available for them. And then one thing that's a little interesting is that we provide the reinsurance to the insurance companies. And so really financially, we back them up in case something happened to them. And then we also provide a producer subsidy for the premium. And so we'll talk about that quite a bit more later on in the program. And so we work with private insurance companies. So in all of the USA, there's not that many RMA employees because we oversee, like I said, the programs and the rules, but we contract with individual or private insurance companies that contract with independent crop insurance agents that actually sell and service the policy. So most, small farming communities have a crop insurance agent or a few of them that know the producers, know the industry, and know how it works. And that's where a grower would go to purchase crop insurance. Like Chrissy and I cannot sell anybody a crop insurance policy. So we work with those companies. The companies sell and service the policies. They do the loss adjustment on the claims, and they report back to RMA. So we have a pretty close relationship with them, making sure the programs are working as they should. So crop insurance, what is it exactly? So just like you might have insurance for your home or your car, it's one of those things you purchase that maybe you kind of hope you never actually have to use it. You might be better off if you don't have to use it, but it's really nice that it's there when you do need it. So most of our policies are based on your production history. So we're looking at what was your average yield per acre for the past 5 years of this crop? And you insure a certain percentage of that. If a natural weather event happens and drops you below that guaranteed amount of insurance that we calculated, then you would get a payment out to bring you up to that minimum guarantee. We do also have policies that are based on revenue. So some's based on historic revenue, some's based on maybe a projected price. And then what we're going to talk about a lot today is the whole farm revenue protection. And that's looking at all the revenue that your farm brings in, insured under one policy. And we also have some area insurance plans that aren't individual to the producer, but are based on what's happening in the area, typically rain. And I'm going to talk about that too, because that's an insurance program that our data tells us is actually currently utilized in your area right now. In addition to the risk management agency and the programs that we provide, the Farm Service Agency also has the NAP program. NAP stands for Non-Insured Crop Disaster Assistance Program. And so if there's a crop that a farmer would like to get some insurance coverage for that RMA doesn't offer a individual insurance plan for, NAP is available through the Farm Service Agency for most crops. And so it's kind of a nice option. And we'll talk a little bit about how that's different from our RMA programs. So the federal crop insurance is really meant to help farmers recover after disaster events or something that causes low production. Historically, decades ago, Congress would have to pass some disaster relief for farmers to get relief. And now with crop insurance, it's the shared risk management tool where people pay in all the time and they get paid out sometimes. And so it works pretty well to give farmers a good safety net. We work really hard at keeping it affordable. There is a premium subsidy that the farmers receive, so they don't pay all of their insurance premium. And we're going to show you an example of this too, and it can be pretty significant in some cases. One other reason that federal crop insurance is really, I guess, ran by the federal government and not privatized is because it is pretty risky. We've seen that lately in the insurance industry with homeowners insurance or in California or something. Once it becomes too risky, the insurance companies won't do it themselves. They would have to charge too much premium to cover the amount of risks that they're taking on by insuring that crop. There are some private crop hail policies where they're maybe insuring against one risk. In our federal crop insurance program, we call it multi-peril, or you'll hear it called MPCI crop insurance. And it covers against all your natural disasters. So it is pretty risky. So that's one reason that RMA exists, is to make sure that that's provided to the farmers. It also, on occasion, is required to get farm loans. The bank wants to know that you have a guaranteed amount of income. And that's basically what crop insurance does. You pay for a certain amount of insurance to guarantee that you'll have at least a certain amount of income for that year. And the goal is to keep people in business after bad years. So organic crops are insurable. I don't know if we have organic producers listening today, but there's just a few things that are a little different. We do offer different categories for conventional, organic that's certified, or transitional organic. And then when we're looking at the causes of loss, we understand that organic farmers may have different limitations for preventing disease, insects, weeds, etc. But they still have to follow the best farming practices that they can and do their due diligence in those areas. So as I mentioned before, we cover all the causes of loss, or many of them. So anything having to do with weather, whether it's drought, hail, freeze, is covered. Fire, if it's caused by a natural cause. Insects and plant diseases, as long as the proper preventative measures were taken. Wildlife, again, if proper preventative measures are taken. Earthquake, volcano, failure of irrigation supply, which is kind of like drought. So if your irrigation equipment got broken because you ran over it with a tractor, that's not covered. If your supply of irrigation water is limited because of drought, that is covered. And then for some of those policies that insure your revenue, price changes are covered also. So the crop insurance cycle, we like to talk about this because it's maybe a little more complicated than other insurance programs we're used to, like auto insurance or homeowners, where you just buy it whenever you want. There is a set date for purchasing the policy. We kind of can make changes to the programs every year, and then there's a window of time where the farmer can purchase it. So there's a sales closing date for most spring crops, for example, that's March 15th. And so you're really purchasing that policy before the perils might take place after you plant the crop. So then phase 2 is after you plant the crop, you report your acreage and you get your summary of coverage and the billing. And then after that, if there's any damage, anything happens to the crop, the farmer needs to submit a notice of loss right away. Contact your agent as soon as you think there's a possibility that something may have gone wrong. Get that notice of loss in there. There might be inspections then, or maybe after harvest. All the indemnity is calculated. You might get paid out. You might not. And then there's a window of time that you can change your policy. And if you don't change it, it's continuous. And so it just carries over for the next year until you report your acreage again and keep that coverage in place. And there's quite a few flexibilities when choosing the amount of insurance coverage that you want. This first bullet says that you can select a coverage level from 50 to 85%. And what that means is of how we calculate your guarantee. So if we're looking at the APH policies, where we look at your actual production history, I'm going to just use 100 as an example. If your average was 100 bushels of wheat and you chose an 85% coverage level, then you're guaranteed 85 bushels of wheat per acre. If you produce less than that, we're paying you out the difference from whatever you produce to get you up to 85. So you can really customize your coverage. If you want a lot of coverage, you can choose a higher coverage level. You're just going to pay a little bit more. Or if you just want enough to maybe cover your expenses, you might choose a lower coverage level. It's cheaper insurance, but you're, again, getting less protection. The lowest coverage level that we have is the catastrophic insurance, known as CAT. You'll hear people talk about CAT coverage a lot. And that's 50% of your production and then 50% of the price election, whatever that is. And for that, we don't calculate the premium based on rates like we do other policies. It's just a flat administrative fee of $655 per crop per county. With CAT, it is more limited. For other policies, there's additional options, things you can add on, like winter coverage endorsement, some extra quality endorsements, things like that. You can purchase with CAT. You're getting the very basic, but the price is right. So I did a little looking into Clallam and Jefferson counties. That's where I hear where most our viewers might be from today. And here's the crops that we have individual crop policies for. And it's really not too many, but that's why we're going to talk about whole farm and micro farm here in a minute. But we insure apiculture, which is the bees and honey, barley, corn, nursery, and then pasture, rangeland, and forage. And I'm going to talk about that one too. So first, we're going to chat about whole farm revenue protection. And this is where you insure all the revenue from your farm under one policy. And it's not like the example I used before about the bushels of wheat per acre. This is just looking at the dollars of revenue you bring in based on your taxes from farm income. And this is nice for diversified farmers where you maybe produce something that wasn't on that list on the last page. If you're doing greens, seed crops, even livestock, all these things can be insured under whole farm revenue protection. There's some up to $17 million of insurance. There are some limitations for livestock and nursery where you'd get capped at 2 million for those. And then you're not allowed to insure timber, forest, or animals for sport, show, or pets. So whole farm revenue protects against the loss of revenue that you planned to earn. And again, that could be due to a natural disaster, drought, freeze, or due to a change in price. It does give you some options for replant coverage. A lot of other policies offer that too. Maybe you plant and it gets flooded out or frozen, or it's too dry and it doesn't germinate. There's replant options. And then it also covers the revenue from a commodity that maybe you were unable to plant. Because again, maybe it was too flooded or too dry to plant. And so you're protected that way too. One thing that's really great about whole farm revenue protection is that there is a diversification discount based on the number of commodities that a grower produces. And again, this goes back to our analysis of the risk associated with that policy. The more crops you have, the less likely you are to have a loss on all of the crops that makes you fall below the point where you would need an indemnity payment. And so the more diversified you are, you can see there's a pretty significant discount to that premium rate for that diversification because you're less risky. You have more crops. So it can be purchased with other crop policies. I showed you the slide that showed there was corn or nursery or some of these other crop policies. You can purchase those individual policies for the crops that you grow and also have a whole farm revenue protection policy. And there's premium offset in there that actually makes it a really nice way to get some revenue protection for those other crop policies that are maybe only based on production. To qualify for whole farm revenue protection, you need to be a U.S. citizen, eligible for federal benefits, file a Schedule F tax form or a substitute covering all of your farming operation, and have 5 years of tax records. Unless you're a new beginning farmer, then there's some exceptions to that. And you have to be involved in the business. So beginning farmer really needs about 3 years of tax records, because we know with taxes, there's a lag from the time you might need to sign up to crop insurance and the time you get your taxes done, that might not quite line up. So for 2025, you would have needed to farm in 2024, but you will need to use your tax records from 21, 22, and 23 to qualify for your beginning farmer or rancher benefits, which I'll explain what those are. And you're eligible for those for up to would be 2029. And there's a 10% premium subsidy. So in addition to the other subsidies you receive, there's an extra 10% discount. You're also exempt from paying the fees if you choose a cap policy. So that's makes that very affordable. You can use the previous producer's production history if there's some qualifications to meet there. But that can be really nice if someone's new to farming and doesn't have their own production history. And then if you have to use yields to substitute in your history, there's some exceptions for that to let you use a little higher yield to give you a better insurance guarantee. So to get a whole farm revenue policy, you have to have tax records from 5 years and a farm plan for your coming year with how much you're going to produce and the expected values. And this is probably the hardest part of whole farm revenue protection, and it's why microfarm was invented, which we'll talk about next. So for whole farm, this production report for the upcoming year can be pretty daunting if you're very diversified. For every crop you plan to produce, you need to have the acres, the expected yield, and the expected price. And there's literally pages in our handbooks on how you determine expected yields and expected price. So if you're a large operation with a lot of history, good solid markets that are pretty reliable, this isn't that hard. If you're a smaller producer and maybe don't have acres of crops, maybe you have rows of your different crops and you don't grow 4 crops, you grow 20 because you sell them at a farm stand or through a CSA or something like that. This is pretty challenging. And this is where microfarm might be a better fit for you. And we're going to talk about that in a minute. So when we're looking at whole farm revenue protection and we're trying to figure out what your guarantee will be for the coming year, we look at the lowest of your 5-year average and then what you intend to produce in the current tax year. The lower of those two is what your guarantee is based on. There are a handful of adjustments that go into that history. If you're trending upwards, there's an indexing feature to trend that history up. And then if you're expanding an operation, maybe you're purchasing more land, more greenhouses, more cattle, there's a factor we can use there too. So you're not necessarily stuck with just that lowest or the average of your 5 years. There's a few adjustments that can be made to that. And then the claims are settled after the taxes are filed. So unlike the individual crop policies where if you get hailed out, the adjuster might come out and look at your field and be like, yep, all the corn is gone. The hail wiped out the baby corn and you're not going to get any production and they'll settle your claim right then. This one, there is a little bit of a lag. So you have to wait till you finish your taxes, which might be 6 months or more from the time the loss occurred or maybe when you expected to sell that crop. So as I said before, the insurers provide your 5 years of tax forms, the allowable revenue worksheet. There's instructions for using less years of history if you only have less years of history or if you're a new beginning farmer. And again, there's indexing, like I said. I got ahead of myself for that one. So, okay, so microfarm. I was teasing you with this one earlier. It's similar to whole farm, but it's really designed to better meet the needs of small scale producers. We kept hearing that the records requirements for a small producer were really hard to keep track of exactly the price per pound of all the different crops, was hard. What is your expected yields? Things like that were hard to justify, hard to track. So this one, we're only looking at your total revenue, and you don't have to look at it by crop. So it is have that sales closing date of March 15th for fiscal filers, on November 20th for late fiscal, or for calendar filers. I'm sorry, March 15th, November 20th for late fiscal filers. This is the same as whole farm revenue protection. And the premium subsidy for microfarm is based on the coverage level you select. And this is similar to whole farm too. For whole farm revenue protection, you don't get the higher subsidy, like this microfarm subsidy, unless you have multiple crops. But here, if you look at this coverage level, from 50% coverage up to 75% coverage level, 80% of the premium is covered by the subsidy. That means the grower is paying 20% of the premium for their insurance. It does change a little bit when you get to the highest coverage levels. And we're going to look at a cost estimator example, and you'll see that in action and kind of what that looks like in practice. So microfarm, like I said, is for the smaller producers, and we've defined that as under 350,000 for a new insured, or up to 400,000 if you're a carryover insured. So that means your second year you can have up to 400,000 in revenue, and up to that 85% coverage level, which is pretty great. And the main feature that's a benefit here is that there's just less record keeping requirements. It also can include some post-production activities like washing, packing, and value-added products like jam. So in whole farm, we have to take out everything. Even if your apples go to a shed and they're washed and put in a box, if that's a little bit of value is added there, we have to take that out of the value of the crop. Where with microfarm, we understand that if you have a farm stand, you might be selling jam along with the fresh berries. And that might be really hard to keep that all separate. And so you're allowed to have some of that into that farm income. So you do have to have at least 3 years of tax records, and including that lag year in there. And then no more than 50% of the farm revenue can be from commodities purchased for resale. Again, you have a farm stand, maybe you buy pumpkins to sell in the fall. You don't grow pumpkins, but you're buying them because people want to buy a pumpkin at the farm stand. Not more than 50% can come from that. And you would have to remove also any revenue from non-farm products. Maybe you sell bottles of water or soda or something like that. That does have to be tracked in there. Okay, I'm going to pass it off to Chrissy now to show you our cost estimator tool.
Yeah, so this is on our public webpage. It's at rma.usda.gov. And the cost estimator tool is just a tool you can use to figure out what it will cost for you to get the insurance you want. And so if you go ahead and click on the cost estimator selection, that will bring you to the next page. And this is what comes up. And from this page, you can choose to look at plan comparison, get a personalized estimate, continue with an existing estimate, change your preferences, and view frequently asked questions. What we're going to do today is we're going to look at that personalized estimate. And then that brings you to this page that you see here. In this case, I'm saying I want insurance for 2025. Since microfarm is under whole farm, we go ahead and choose an insurance plan as whole farm revenue. And then you choose the state and the county in which you are going to be applying for insurance. And then you hit continue. And this is where you specify that you want to do microfarm. So you can see right there, it says microfarm, and then you go ahead and hit add that item. And that is going to lead us to the page where you really fill out all the information. And so you get to choose the type. So this is where we're talking about the early filer, the late filer, the calendar year filer. I just left as a calendar year filer, so it's that March date. And then the practice would be like irrigate, organic, but with microfarm, that's not an option here, so it's no practice specified. And then you get to select here if you qualify as beginning farmer rancher, which Lacey already kind of went over. For this example, I just selected no. And then the next one is, does conservation compliance apply? And so this is something where you would work with NRCS if you're wanting to farm on highly erodible land, or if you're wanting to convert a wetland or drain a wetland. That has to be done with NRCS. If it's not done with NRCS and we don't have all that figured out, then we can't pay the subsidy. And so that really is something that you can work with. And NRCS is the National Resource Conservation Service. It's also part of the USDA. It's one of our sister agencies. And then the next one is the expanded operation. In this case, I selected no. I have the same number of acres. I'm not increasing acres. But if I were to increase my acres, then I would try to figure out what my increase in revenue is. And that's where that factor we put in on the next box. And that can go up to 35%. So even if you increase your farm number of acres by 50%, we're still capped at 35%, unless there's falls into some very specific allowances. And then the next option is indexing, which Lacey also discussed. In this case, I don't want to opt out. I want to stay in because in this example, I've been increasing my revenue each year. And so I want this calculation to acknowledge and to calculate my allowable revenue based on the fact that I have been increasing my revenue each year. And then under allowable revenue, I went ahead and just put in 5 years of history. And that shows that there's an upward trend in my revenue. And then for the next one, under commodity values, that's my expected commodity value. And then from there, you can hit get estimate. And this is really the exciting page. All the other stuff was just leading up to this. When this pops up, this is actually, you'll only see one of these sections at a time. But the first one we're looking at is the liability amount. So if you choose 65% coverage, then you're guaranteed that payment of $39,000. That is what you will pay, whether we're paying part of it or you manage to bring in that much revenue. Either way, that's the guaranteed amount. And then if you look at the producer premium amount for that same 65%, the producer is only paying $484 of the total amount of the premium. And so what is being subsidized for that same 65% is $1,934. And so the farmer is paying 20% of the total premium amount.
Great. So I think Chrissy did a great job. I just have to say again, I think it's a really nice picture to be able to see. For $448, a producer can guarantee their income of $39,000, whether that's from their own production or if they fall below that, the insurance would get them up to that $39,000. So, great example. I'm going to move on a little bit from microfarm to a couple other programs. We do have a dairy revenue protection program and other livestock programs. I wasn't going to spend a lot of time on those today, but the way the dairy program works is it's really comparing your actual revenue against the revenue that you purchase, like a guarantee, insurance guarantee. And so it's almost like hedging. You're looking at the projected price, purchasing this much production or protection, and then that gets compared to what you actually produced. And it does not protect against the death of the cattle or anything that happens to your operation. If there's a natural disaster or something, it's looking at the actual price of the milk you sold versus the guarantee that you had in your insurance guarantee. So then I also want to talk about our pasture, rangeland, and forage program. This is something, again, that I'm looking at what insurance programs are used in your area. This is one that is utilized. It's an area plan of coverage based on a grid. It's not based on individual producer, and it's not based by county. It doesn't measure the individual's production. It's just looking at these numbers in the grid, indexed based on a deviation of normal. And the grid that we're looking at is based on rainfall. So we'll talk about that a little bit more. the one nice thing is there's no loss adjustment, no production records. You can purchase it, and if there's a deviation from the normal, you may be eligible. So this covers all perennial crops planted prior to July 1 for haying or grazing. And it's a rainfall index program. This is similar to apiculture, which I'm also going to talk about. The grids are about 17 miles by 17 mile squares. We base everything off NOAA data, and we look at a deviation from the normal since 1948 to present. And like I mentioned, the other crop policies are multi-peril. This is single peril. We are only looking at precipitation. So it's not necessarily drought insurance, where we don't consider it, if it could be hot and dry or windy or something like that. This is only looking at rain. And it doesn't matter if there's a drought declared by the state. Every now and then we'll get that. Like, our county was declared a drought by Washington State and we didn't get a payment. It's like, well, what did the grid say? The NOAA data for the grid. That's the only thing that applies for PRF. It's very similar to apiculture. This is designed to ensure loss of honey production. Again, just looking at that rainfall index. And it's available everywhere in the US. So I'll take you back to our website here for a minute and show you where the agent locator tool is found. So Chrissy showed you how to go to tools and reports and go down to cost estimator. We have a great agent locator tool on here also. And that's how a producer would find an agent to purchase a crop insurance policy. Also, if you're a beginning farmer and rancher, there's a getting started section for beginning farmer and ranchers, which is a good tool also. And kind of leads you through some of your options. And that is about all we had. I know we're a little ahead of schedule here. This is the contact information for our office here in Spokane. I threw my email in here, and I'm happy to answer questions over email. And I think we're also going to take questions over the chat.
Thanks, Lacey and Chrissy. Appreciate that. It's all kinds of good information. It does look like we have some. One question in the chat came up during the cost estimator portion. Alicia asked everybody, what if we are both beginning and veteran farmers?
I have the policy pulled up. Do you want me to answer that one, Lacey?
Yes, that would be great.
Okay. So the veteran farmer or rancher, you can qualify as that in 3 different ways. If you have no farming experience, if you have less than 5 years of farming experience, or if you first obtained status as a veteran during the most recent 5-year period. And so if you are beginning farmer and rancher and a veteran, it would fall under the veteran farmers.
Thanks, Chrissy. Hopefully that answered your question, Alicia. Any other questions from our attendees? I know there's just a couple of you, but any other things that pop out or anything that Lacey and Chrissy can answer for you or I can help?
I have a few questions, Paul. This is Kelly.
Yes, thanks, Kelly.
And I don't know, Lacey, if you want to stop sharing your screen, that might be helpful. Great. So thank you so much. That was really quite interesting. And I have a few questions that came up for me on behalf of some of the farmers that we work with in our areas. We have so many specialty crop producers that are growing vegetables, herbs, tree fruit, other horticultural crops. And you explained both the whole farm revenue protection program and the microfarm program, but I'm curious about the USDA specialty crop program. Is this program still relevant to smaller farms? Are there different eligibility requirements? I'm thinking of some of those farmers that grow, 50 varieties of vegetables that sell at farmers markets and do some wholesale selling. Can you speak to that?
Yeah. So for crop insurance or for RMA, we don't operate in the same kind of categories of specialty crop as some of the other parts of USDA do. Really, our microfarm and whole farm is designed for the specialty crop producer. It's the best tool that we have. So we do have individual crop policies for a lot of tree fruit and for seed crops and for vegetables and things like that. However, for someone you just described to as 50 crops of maybe really unique, diverse things, that they would consider themselves a specialty crop producer. Really, the whole farm and microfarm would be the perfect fit for them. And if they're under that limit of 350,000, microfarm would be a great fit. Because keeping records for 50 different crops and reporting them all individually, like you would need to with whole farm, could be quite challenging. But if they're under that limit, whole farm would be excellent because it is designed for those specialty crop producers where we don't have enough data to develop an individual crop policy, if that makes sense. So for a policy like corn or barley, we need a lot of data to develop an individual crop policy. We can get that for those mainstream crops, like a corn, and know what the rate should be to make sure we're not insuring something that's too risky, right? We need a lot of data to be able to develop an insurance policy that's sound for an individual crop. So we can't do that for kind of niche crops or really specialty crops. So that's where like whole farm, microfarmer, a really nice way to do that because the farmer has produced that over a season of time. We look back at their history. So it's a pretty safe way to ensure their historic production.
Wonderful. Thank you.
Yeah.
Thank you for that clarification. I have a few more questions, if that's all right. You spoke about prevention measures, the farmer taking prevention or some measures to prevent some of these losses. And I'm just curious if you could expand on that. For example, wildlife damage, what kind of prevention measures that would look like, or some other examples I could think of are changing pest pressure as we experience different weather and climate patterns and or greenhouse crops grown in greenhouses.
Yeah, those are great questions. So when that would come into play is if a farmer had a loss and the loss adjuster goes out and maybe the field was entirely wiped out. I could use cherries and birds. Let's say all the cherries were destroyed by birds. The loss adjuster might look at that and think, yes, there was bird damage. However, there was no netting, there was no cannons, there was no streamers, there was no effort at all to keep the birds out of the orchard. This isn't crop insurance's responsibility to pay out this loss. They were not following good farming practices. So they could deny the claim based on good farming practices. So RMA, our agency, doesn't define what a good farming practice is for every situation because it's different by crop and different in probably even by county in some places of Washington. What your pests are vary a lot. So if a claim was denied based on good farming practices, the insurance company or possibly our agency would get involved and go to local experts, probably extension, like maybe WSU extension, and ask, what is the best practice in this region? What's the standard practice to prevent this pest from causing this problem? And again, that might be different with organic versus conventional too. And so really that would apply all the way across the board, even with weed pressure and pesticide resistance. Did the farmer apply the chemicals at the right time under the right conditions? Or maybe they applied them, but Mother Nature didn't cooperate. The farmer did his best farming practice and Mother Nature, it rained after he put the chemical down and so it wasn't effective or something like that. But they would need to show that they had followed their best farming practice, the best they could under those conditions. And again, we don't define what that is for every situation, but we would go out and look to local experts to make sure that they were followed. We just got back from a meeting in Oregon and talking about grass seed, and there's slugs and geese and a lot of different situations to protect the newly seeded fields against slugs and geese. And there's a lot of things you can do and a lot of things that don't work and a lot of challenges to keep geese out of the field and prevent slugs from eating the grass. And sometimes you can do everything right and it's too wet and the slug bait doesn't, dissolves before the slugs eat it. And that's a situation where crop insurance would still probably pay out that situation. If the farmer never put out slug bait and never tried to kill the slugs and the slugs ate all the grass before it got established, then they wouldn't have been following the best farming practices. Does that kind of answer your question?
Absolutely. And that makes
Okay.
me think of farms having integrated pest management plans in some of their record keeping, could address that or at least demonstrate their practices.
Yeah, absolutely. The records are a big deal to show that you purchased what you needed to purchase or had the system in place and executed that plan. You need records to show that if it got to that point.
Another question I have is around wildfire impacts. And a lot of our farmers out here are impacted one way or another, not necessarily by fires themselves, but the smoke impacts of the wildfires around the region. Is that applicable in this scenario? I'm thinking of a few crops that may be affected. For example, some wine crops are affected by wildfire smoke. That may or may not be the case here, but could you address that question?
Fire gets a little complicated sometimes because it does need to be from natural causes. However, maybe it was ignited by a man-made cause, but it was a disaster because there was high drought, extreme drought, and high wind. So in those cases, it's down to the insurance company to really determine where the smoke damage came from. Was it the man-made fire that it started the fire, man-made cause, or was it the extreme natural conditions that caused it to get out of control? So in many cases, it has been covered because there has been extreme drought and extreme wind and things like that. So that's step one. Step two would be proving that the damage was caused by smoke. And so that has been a process. I know you used wine as an example several years ago. It was pretty hard to determine if the grapes were smoke tainted or not, what are the markers we're looking for in a lab, how do we prove that, how do we get the insurance companies to accept that. We've made they've made a lot of strides in that, and so we've come a long ways. So there's much better evidence there, and that is an insured cause of loss. With grapes specifically, there's a new insurance program that has come out in California, and hopefully we'll get it in the Northwest before too long. That is an index program, kind of like I talked about the rainfall index for PRF. They're working on one that's a smoke index for grapes. And so if the smoke gets above a certain density in your area for a certain amount of time, you can get you'll get coverage or get paid out if you purchase the smoke coverage. Regardless of having to prove that your grapes have smoke damage or not, if the smoke was heavy enough in your area for enough time, there's an opportunity for an indemnity payment. I'm not sure what other crops are affected by smoke, but it could be, there's a chance for coverage there if you can prove that the yield loss or the value was due to smoke damage.
Yeah, I was going to ask about that because in Sequim in our area, there's a high concentration of lavender farmers, myself included. And we did notice some smoke affecting our value-added processes. So in making essential oil, a couple years back, we had several bad batches of oil because of the smoke on the flowers when we made the oil. So I'm wondering if something like that might be available for protection under this program eventually.
Yeah, I would think for a micro farm type protection, we're looking at the revenue from your operation. So one thing nice about revenue protection that automatically includes quality.
Okay.
It is more complicated where you're doing the value-added processing yourself. So you have less evidence that your buyer is rejecting it due to a quality issue. It is kind of nice when if you're selling it and they maybe are paying you a certain price, but then since maybe there's some smoke damage and they're gonna have to blend it out, they're gonna pay you 50% of that, and you have evidence of that. That would make it nice and cut and dry for crop insurance purposes. When you're doing it yourself, it's a little harder. You probably need some evidence that quality was poor of some sort, but there's ways to make that work, I would think.
Thank you.
I have one more question around drought and irrigation and water, because that's something that's on everyone's mind, and it's specifically out in some of our areas. There are irrigation and drainage districts who manage agricultural water. And you mentioned in your presentation that irrigation supply, loss of irrigation supply is covered under some of these programs. And, two audiences of farmers who are either in an area where the water's managed by a supply district, and then other areas they're not, but they're incurring some drought damages with some of their irrigation, groundwater supply, or what have you. I just wanted you to emphasize that for some of the small farm, and if there's a particular message around assessing risk and managing water, irrigation water on a micro farm or a small farm.
Um, so there's a couple things to consider as far as insurance goes. It is very cut and dried. If you have a letter from your irrigation district saying you're going to get 60% of your allocation, then as a farmer, you can choose to plant 60% of your land, or you can change your crop mix. Instead of planting something that requires a lot of water, maybe you're going to plant something that requires a lot less water so you can still utilize all your land, and just apply less water to some of the crops or something like that. And so I guess that same concept would apply to a micro farm type operation where you could adjust your crop mix or plant less. If you're thinking again from a crop insurance perspective, you would need to document it pretty well that you've done the best you could, with the amount of water you have. Micro farm's kind of nice where you just look at your total revenue. So if you planted less of your land and your revenue was down because that's all the water you had, all the land you could irrigate, then that's pretty simple.
So in the event that there's a emergency drought declaration mid-season and water supply was cut off, and the farmer has no time to change their planning because crops are already in the ground.
Yeah.
Though if they're enrolled in these programs, then those crops will be covered.
Yes, that would be an insured cause of loss. If you have a significant loss of yield because of losing your water mid-season, or the streams, like you said, if you're not in an irrigation district, sometimes you might the water just runs out. You might not have a letter, but it's gone, or the well's low. So that would be covered, especially if there's evidence of a drought. We don't base crop insurance decisions based off drought declarations, but that could go into a determination if there's not a letter from an irrigation district or something else. If we're trying to determine, is there really a drought? We'll look at other weather data, what stream flow sources, but drought declarations could be part of that consideration. And then something else that's extra tricky in this situation is if you have perennial crops. So maybe you have grapes or trees, you need to keep them alive. Are you going to apply enough water to keep everything alive, or water some of them enough to actually get a crop? And so it gets really, those are tough situations that farmers have to make. That happens a lot down in like the Yakima area, the Rosa district. They often don't get their full water allocation, and they're trying to figure out how to mitigate that damage, not only that year, but for, the years to come. How to keep everything alive, but maybe still get some revenue somewhere. Those are tough calls a farmer has to make.
Thank you so much. Those were my questions.
Those
Lacey,
are
in
great questions.
making those decisions, who would a farmer contact for guidance as far as when they're looking at crop insurance specifically? Like, is there a resource in your office, or I know obviously the conversations they'd be having with us and WSU, but specific to the insurance coverage, is there a resource, someone they can reach out to?
I think between working with local extension and their crop insurance agent, because the agent has probably dealt with this before. They have policies probably all over that region or even all over the state, and have worked with growers quite a bit. And then if anyone called here with questions, I would probably send them to extension, the local extension agent, to get the best advice on how to mitigate that damage on their operation, suggestions for low water crops, things like that.
Thanks. Okay. Well, thank you so much. That was super insightful, and I might have some follow-up questions for you down the road. Um, but I think right now we can pop up. We've got a resource list of links you can contact. I think we've got contacts at the RMA, and I think Kelly's going to pull that up here on the screen here. Contacts for Kelly and I, and some other links to agent locators and some other things. And while we're looking at that, for the folks that are on the call today, there is, or there will be, a survey link, an evaluation in the chat. If you could click on that and just fill it out real quick for us, we'd appreciate that. That's going to help us with our grant reporting and whatnot. And we appreciate you coming. Spend just a few minutes taking a look at this, and want to remind you to check the WSU Extensions webpage, Regional Small Farms webpage, for the other upcoming classes. You can check the NODC's webpage as well. We've got class coming up on grant. On grants, we got class coming up on farm management, some other classes regarding agritourism and brand development. So lots of good classes for people who are getting into it and want to develop their business a little bit better.
Thanks, Paul. I just put the link to our class evaluation in the chat. So those of you who are here, please go ahead and click on that link and fill it out before you leave today.
Thanks. And did you have that slide to throw up for the resource list so they can take a look at that?
Yep, it's up right now.
Oh, is it? I'm not seeing it.
Oh, can you all see that?
I can see it.
Oh,
Great.
It's interesting. There's a tab up top. I see it when I click the tab. So great. Thank you so much.
Yeah. And any follow-up, post-class follow-up details we need to explain, Paul?
Yes, I think aside from the evaluation, we will send out this resource list as well as the slide deck from Lacey and Chrissy's slide deck. And I think what else was on the follow-up? You'll get links to that, and then probably some more information about the upcoming classes as well. So keep a look out for that in your emails in the coming days.
Great. I don't see any other questions in the chat. Well, thank you so much, everyone.
Thank you. Yeah, we appreciate it. Thanks, Lacey and Chrissy, and thanks, Kelly.
Great, thank you.
And
Thank you.
I'm sure we'll be in touch again. Thanks.